Hey everyone, welcome back to the channel. If you're tired of the 9 to 5 grind and want your money to actually start working for you, you're in the right place. Today, we're looking at the ultimate cheat code for 2026, high-quality dividend stocks priced under $50. Most people think you need a massive windfall to start investing, but honestly, consistency beats luck every single time. We've analyzed the cash flows, the payout ratios, and the growth projections to bring you 10 gems that are perfect for a Tier 1 portfolio. Before we dive into the list, let's talk about why 2026 is a unique year for dividend seekers. With the global economy stabilizing and interest rates finding their new normal, companies with strong balance sheets are returning massive amounts of value to shareholders. Buying stocks under $50 allows you to accumulate more shares, which means more frequent dividend payouts and faster compounding through DRIP, the dividend reinvestment plan. It's about building a snowball effect that eventually becomes an avalanche of cash. Coming in at number 10 is Vici Properties. If you've ever been to Las Vegas, you've seen their assets. They own the land under some of the most iconic casinos in the world. In 2026, Vici remains a powerhouse because their leases are triple net, meaning the tenants pay the taxes, insurance, and maintenance. It's a rock-solid REIT that currently sits in that sweet spot under $50, offering a reliable yield that has grown consistently since their IPO. At number 9, we have Pfizer. Now, I know what you're thinking, healthcare has been a roller coaster. But in 2026, Pfizer has pivoted heavily into oncology and mRNA breakthroughs. Their valuation is incredibly attractive right now, often dipping into the $30 range. For a company with this much cash on hand and a commitment to a 4 to 5% dividend yield, it's a staple for any defensive portfolio looking to weather market volatility. Moving to number 8, let's talk about the energy transition with NextEra Energy. They are the world's largest renewable energy company, but they also own a massive regulated utility in Florida. This best of both worlds approach gives them the stability of a utility with the growth of a tech stock. In 2026, as the world pushes harder for green energy, NextEra is poised to keep hiking that dividend. It's an essential pick for anyone looking for green passive income. Number 7 is a classic, Kinder Morgan. As one of the largest energy infrastructure companies in North America, they move the natural gas that powers our world. Their business model is like a toll booth. They get paid based on the volume of gas moving through their pipes, regardless of the commodity price. This makes their dividend incredibly safe. In 2026, natural gas is the bridge fuel for the world, and Kinder Morgan is sitting right in the middle of it. Sliding into the number 6 spot is Huntington Bancshares. If you want exposure to the financial sector without the volatility of the Big Four banks, this regional powerhouse is it. They have a massive footprint in the U.S. Midwest and a very conservative lending profile. In 2026, regional banks are benefiting from higher for longer margins, and Huntington has a history of rewarding shareholders with a dividend yield that often eclipses 5%. We're halfway through. At number 5, we have Verizon Communications. Look, everyone needs a phone and internet. It's basically a modern utility. Verizon has spent billions on their 5G infrastructure, and in 2026, they are finally reaping the rewards. While the stock price stays relatively stable, the dividend yield is the real star here. It's a cash flow machine that pays you to wait while the company continues to dominate the American telecom landscape. Coming in at number 4 is a brand you definitely have in your pantry, Kraft Heinz. Backed by big names like Warren Buffett, this company has spent the last few years streamlining its portfolio and paying down debt. In 2026, they are leaner and more profitable. When inflation hits the grocery store, Kraft Heinz has the brand power to raise prices without losing customers. This protects your dividends and ensures your purchasing power stays intact. Number 3 is the tech turnaround story of the decade, Intel. After a few rough years, their massive investment in US-based chip manufacturing is finally paying off in 2026. While they aren't the highest yield on this list, their growth potential is astronomical. They are the backbone of the Made in America semiconductor movement. Getting into Intel under $50 is a strategic move for both a decent dividend and significant capital appreciation over the next 5 years. At number 2, we're looking at Franklin Resources, also known as Franklin Templeton. This is a global investment management firm. Why do we like them in 2026? Because as more people enter the markets, these firms collect more fees. They have an incredible track record of raising their dividend for over 40 consecutive years, making them a dividend aristocrat. It's a pure play on the long-term growth of the global financial markets, priced perfectly for retail investors. And finally, our number 1 dividend stock under $50 for 2026 is Ford Motor Company. I know, a car company? But hear me out. Ford has successfully balanced their traditional truck business with a highly profitable commercial EV division. Their dividend is often supplemented by special dividends when they have excess cash. In 2026, Ford is the dominant force in the American work truck market, and their yield is one of the most generous in the S&P 500. Now, Picking the right stocks is only half the battle. To really get rich, you need to utilize the power of compounding. By setting your brokerage account to automatically reinvest dividends, you are buying more shares every time a company pays you. You don't even have to think about it. By the time 2030 rolls around, your share count will have grown significantly, and so will your quarterly checks. That is how true wealth is built in the Tier 1 markets. Of course, investing carries risk. You should never put all your eggs in one basket. Diversification across these 10 stocks helps protect you if one sector, like tech or energy, takes a hit. I always recommend keeping a core of your portfolio in low-cost index funds, and then using these individual dividend picks to boost your overall yield. Always do your own due diligence or speak with a financial advisor before making big moves with your hard-earned cash. If you found this list helpful, do me a huge favor and hit the like button. It really helps the channel out. And if you want my 2026 Dividend Growth Guide for free, check the link in the description below. Don't forget to subscribe for more deep dives into how to master your money. I want to hear from you. Which of these stocks are you buying first? Drop a comment below and I'll see you in the next one.